What's up, outliers? Today we're going to talk about hedging with options. This is hands down one of the most misunderstood topics with respect to retail options trading. And it's because retail traders have a really messed up way of approaching hedging that leads to the worst possible outcome, which is where we're increasing our friction, our total cost, but also reducing our profitability. So we're going to walk through some of the core concepts as to why that's the case. We're going to talk about some ways to hedge smarter, and then I'll give you a couple examples to help tie everything together. So the base here, as you know, options are strategic investments. They're designed to create very specific risk-reward profiles. They also allow you to speculate, so trade an idea that you have, or hedge to reduce risk. So what is the concept of hedging in a nutshell? Well, that's it. It's literally just to reduce risk. I view it in two different concepts. The first way is a direct hedge. The second is indirect. These are not industry terms. These are my own, but it helps me organize the way I think about hedging. So when we think about a direct hedge, the entire purpose of the position, in effect, is to lose. Why would we put on a position that we want to lose? Because the purpose of a direct hedge is to offset the risk of a primary position. And the preferred outcome would be for the primary position to win, which would mean that our hedge would lose. And if your mind immediately goes to, well, what about if I put on the hedge and then I make money on the hedge, but then I make money on the main position? Well, if you can solve that, you've solved the market. But more importantly, this is one of the big issues that retail traders have with the concept of hedging, is because that's what they want to happen. But that's not how this works. And I'll explain why. There's different kinds of direct hedges, stuff like static dynamic. One you put on, you leave, the other one you adjust. Stuff that attacks the tails of the distribution. So if you think of a distribution curve, it's really not worrying about one standard deviation moves, but we're getting out to like 3+ standard deviation moves that we're trying to remove the risk of. We'll get into all those in another video, but know that there's different kinds that exist. And then this idea of an indirect hedge is simply a speculative position that you put on that happens to also decrease the total portfolio risk. So the way that I look at something like a direct hedge is I'm putting it on, its entire goal is to reduce risk, and that's the standard I'm holding it against. In indirect hedge, I'm putting it on to make money, but it happens to fit in with the broader portfolio and serve a risk reduction purpose as well. And I'll show you what that looks like. If we take a look at S&P, you can see S&P is cracking new all-time highs. So let's say that we have a portfolio that's long S&P. Great. Then if we take a look at healthcare, healthcare is going down. However, sometimes this will have a positive correlation. So what we can do is have a base position that's long SPY, but then we can have a position that's short healthcare. Because even though healthcare right now is going down as SPY is going down, if SPY broadly goes down because of some sort of market crash or something like that, it's very likely that healthcare is going to follow. So that's just a very base idea on how to take a directional speculative trade, the idea that we think healthcare is going to continue to go down, but it also reduces some of the broader portfolio risk by taking off some of our deltas, which you'll learn more about that in a few minutes. So within this process of hedging, I think of it in a few different levels. I have direct portfolio hedging, direct trade level hedging, and then that concept of indirect hedging, which can apply primarily at the portfolio level, less so at the trade level. So what do these mean? Well, if I'm thinking about direct portfolio hedging, this is where I'm looking at a broad portfolio, and then I'm putting on individual positions to attack the broad portfolio level metrics, which you'll get an example of in a moment. The way that I do this is I look across the portfolio and I break it out into its base Greeks. So I look at things like its net, the total, delta, theta, gamma, vega. Then I can beta weight those to give me some context, align them, come up with notional values. And then I could put on positions that help address any excess risk that I see. Then direct trade level hedging is when we're looking at an individual position and we're putting on a hedge specific to that individual position. So again, simple example here, let's say that I'm going to trade earnings and I typically sell strangles. Well, if I see something that maybe has really big moves, maybe I buy a wing, which you'll get an example of in a few moments. Indirect hedging, we already looked at an example of this, but the way to think I approach and the way to think about something like hedging is I have a lot of indirect hedging activity, but the way that I implement direct level hedging is very sparingly. And it's because there is a high cost associated with hedging, which you'll get a sense of in a few moments. So here's a very basic process that you can follow. And I will get myself out of the way so that you can see. There we go. So we start by defining the goal. This is super important because you'll see that this idea of carrying a perpetual hedge really does not work well. This is another common mistake retail traders make because they think they see institutions doing this. And in a lot of instances, institutions will, but it's because they have a completely different world they operate in. They have to maintain certain exposures. They have big positions. It's not as easy for them to scale into and out of things, which can be way more efficient. So we got to define the goal of the hedge. So what's a good goal? Let's say I'm holding shares of a stock and it's coming up on earnings. I want to hedge it through earnings. That's an okay goal. Now, we have to measure the risk that we're trying to hedge for next. The way that that works is I need to take a look at the position I have on and determine how much risk am I comfortable taking through this earnings release. Am I comfortable if the stock goes down 20%? Am I comfortable if it goes down 40%? Where's the line in the sand? Because I have to figure out where I need the hedge to come in, because the next step is to actually build the hedge. So this is when we determine what the size of the position needs to be, what the risk offset is. This is another really common mistake by retail traders, where let's say that we have 100 shares of a stock. Their instinct will be, well, I need to have 100 shares of a hedge, essentially a complete hedge. That may or may not be the case. The way I think about the offset is I typically want to take off a percentage of the risk. But if you overhedge, you're now eating more and more into your return profile. The duration has to be carefully selected to fit the broader idea. And then this is another massive mistake common from retail traders, which is there's no management plan. So then as the hedge is working, unfortunately, because it means the base position's not working, then the questions come of, well, when do I take this hedge off? And it's a great question because there's a very difficult decision you have to make, because when the hedge is making the most money is typically when you need the hedge the most. And I'll give you a way to think about striking that balance in a little bit. All right. So let's now double click into this idea of direct portfolio level hedging. Here I have a portfolio. These represent all different kinds of individual positions. And as discussed, the first thing I want to do is take stock of these individual positions and normalize them. So I'm going to do something like beta weight the deltas against something common like SPX or SPY. And then I'm going to figure out the rest of these details. So if we take, for example, this portfolio here, and we're going to say that it has 1,025 beta weighted SPY deltas. This means that the notional value of the portfolio is $640,000. This does not mean you have $640,000 at risk. It means that your portfolio, as SPY moves, it's going to behave similar to $640,000. So if you look at that and let's say you have a $500,000 portfolio, you might say like, oh shit, I'm levered. I don't want to be levered. Or you might say I have a $2 million portfolio and say, oh shit, I have to put more risk out. I don't have enough on right now. Now, this is not the definitive tool to determine your sizing. It's just a tool. Next, we have our theta calculation. I don't go through all of them, but in this context, I see that I'm long 640 theta, and let's just say that that number is good. I don't need to make any adjustments. But as I'm looking at this, I say, I actually don't want to be long 1025 SPY deltas. So then I can now decide on a portfolio hedge. I can either pursue an indirect hedge and just simply say, I'm going to look for speculative trades that have short beta weighted deltas. So again, a great example of that is what I gave you in healthcare before. If I sell calls in healthcare, that's going to have short beta weighted deltas. It's going to take off some of my long risk. That's an indirect hedge. A direct hedge would be something like, I'm either going to sell some calls in SPY or whatever the bigger position is here. There's a really common mistake traders make where they think that they should use VIX. VIX is a whole other ballgame. When I think about hedging, I would not use in general VIX as a direct hedge. If there's a speculative idea in VIX and it serves an indirect hedge purpose, that often can make sense. It's a little outside the scope of this video, but there's a lot of nuance when it comes to VIX. You have to remember VIX is the 30-day implied volatility of S&P. So not only do you have to worry about the relationship between whatever the individual positions you have and the correlation to VIX, but also the severity of VIX, how much VIX happens to move, because it doesn't always, it's definitely not completely inversely correlated. There's different magnitudes to SPY and so on and so forth. So using volatility can be done, but it's a little more complicated than people think. And normally if you just buy calls, you're just lighting your money on fire. Like that's generally what's going to happen. Now let's take a look at direct trade level hedging. This one's super simple. So as I mentioned before, let's say that I'm looking at a short strangle and something that is really high volatility earnings. And normally I would sell strangles. And I'm looking at this stock, the expected move is 20%. Let's say that this is the historic expected move. The implied move that I'm seeing is 21%. So we're getting about a percent edge in terms of the move expectations here, but that's pretty tight and it has a really volatile history. Maybe I'll just buy a wing so that this way I can change my risk profile. Because when we think about a standard short strangle, if I have a P&L graph here, this is going to be my short strangle. But let's say that I deem the risk is only to the upside. I don't want to get ran over on the call side. So maybe I'll buy an out of the money call so that I don't have this unlimited upside risk. I still have the unlimited downside risk. Let's just say I'm okay with that. This is the process of defining. It's being very specific about the risk. I could say, well, I think it might go either way. So then I choose to take it into an iron condor. But again, this serves as drag on the total returns that I have to pay attention to. Otherwise, you can start losing way more than you're trying to lose. And you'll see why in a moment, this concept of drag. Now, this is the example of indirect trade hedging. And again, this is where we have different kinds of plays that make up a well-built portfolio. And the idea is you're going to have some stuff that's making money as the S&P goes up. Some will make money as it goes down. I tend to like to be positive theta. So then if I'm noticing I don't have enough positive theta, maybe I'm going to go sell some premium. But this is the process of just building a balanced portfolio. Indirect hedging should be continuous, in my opinion. So let's talk about these good and bad habits. And you'll notice that there are a handful here. So one of the worst possible habits is just blank fear of risk. This is probably the most common one, where traders just don't like risk. And if you ask them like, hey, what are you hedging for? And they'll say something like, oh, well, if the stock drops 15%, I don't want to deal with that. And then you'll ask them, oh, so like, would you sell? And they're like, oh no, this is a long-term hold. Well, now we just have a completely mixed up world where if this is some sort of long-term hold, but you're concerned about a 15% drawdown, you're probably in the wrong stock or you're probably oversized. Now, for shorter term traders, people that run momentum or breakouts or can slim or trading options, that's different because you cannot allow risk to get out of control. So for the trading side of the world, it's a little bit different. So the next bad habit is you're not attaching a very specific duration to whatever your perceived risk is that you're looking to hedge away. And then you don't have a plan, which we already talked about. The most common version of this is there's no exit approach. It's just put on something to control. You're not measuring how many deltas you're taking off. And then you end up with this position that is actually taking too many deltas off. You're decreasing your profitability. And then as the hedge is making money, you take it off and then the thing goes down further when you really need the hedge. You have to have a very specific definition of what you're trying to hedge, why, so that you can create a management plan around it. The poor Greek profile is really important to keep in mind. So if we take a look at an example for that, let's say that we're in SPY and I'm going to go out. This is part of the example you're going to get in a minute, but I'm going to look at some different expirations. If I come closer in time, I already know that I'm going to get more gamma. So then if I'm buying near-term options, though, I also know the theta decay is very high. So again, this goes back off of defining what the hedge is supposed to do. If it's just a perpetual hedge and you're like, well, I just want to take off some of the risk in this thing long-term, and you choose to go out here to 15 Jan 27, but then for your hedge, because you don't want to pay $3,000 for your hedge, you're like, well, I'll just go super far out of the money. Well, if you go super far out of the money and you have a really low delta, guess what you also have really, really low, super far out in time? Gamma. So that means that the quote unquote deductible, which you're going to get a sense of in a moment, is going to be astronomically high. Your hedge effectively isn't going to be hedging very much. It's more of just a feel good position, which is bad form. We already talked about volatility a little bit. The next key thing to pay attention to with respect to volatility is that it does not impact all expirations the same. You have to keep that in the back of your mind. And then the last thing that we just touched on is this idea of a deductible, which we'll talk about in a moment. The main thing I want to highlight from the good habits, which we talked about all of these already, but the specific one is simpler hedging. As a retail trader, you have much better ways to hedge than the really expensive direct hedging. You can size your positions, you can scale in and out, you can implement indirect hedging that naturally has a risk smoothing impact on the portfolio. Those are so much more efficient. This does not mean that there's never a case for a direct hedge. But again, as I mentioned earlier, it should be specific. So if I'm holding a stock and I want to protect it against a 30% drop, I want to offset 45% of that risk. It has earnings in 6 days, so I want to hedge it throughout that earnings event. I'm going to use something that gets me the correct exposure in terms of gamma and delta. And then I'm going to have a very clear management plan for that position. So let's say that I'm holding the stock. I'm going to buy a 40 delta put that's, let's say, a month out to try to decrease some of the really short-term option effects. That'll give me enough gamma that if there is that 30% drop, it will offset the risk that I'm looking to offset. That kind of thing. Now, let's take a look at a quick example with SPY at 625. And let's say you have 100 shares, and then you're going to buy to open the 46 data expiration 610 put for $6.42. This is a 30 delta. So this is about 46 days out. It will have moderate gamma, not a ton, because these are also a little further out of the money. But let's take a look at this idea of a deductible. The deductible in this context is the difference between whatever your basis is and whatever you, in this context of the long put, are going to be defining your exit. And this is really part and parcel to long puts. And it's because long puts, they move, and you'll see what I mean. So the deductible in this case is 15 points, essentially. It's the difference between spot, whatever your basis is, and then the long put strike. So then you have to tack on your cost, which is $642. So your max loss on this trade is now 21.42. It's not bad. But there's a little bit of nuance that we have to pay attention to. One of them is that if we look at this 1.03%, that's the drag that this takes for 46 days. So that's a problem. Because if you maintain constant exposure with this, this is like a 8% annualized drag. So that means in order to have a positive return, you're going to have to return over 9% on the year at a base minimum to overwhelm the drag that you are incurring from this position and keeping that 46 days to expiration across the board. So what's the impact to your P&L? If SPY goes up by 5%, with the long put, your P&L is $2,600. If you do not have the long put, your P&L is $3,125. So it's about a $525 difference. The reason why I show you this is it shows you at what point, at least to the upside, is the effect really felt of this position. Now, to the downside, it will have a profound effect because we already know what our max loss is as compared to 100 shares here. So the last thing that I want to show you is that if we get this 5% up move, that means SPY is now at 656. Our risk grows, your deductible grows because your put is still down here at the 610. So your original risk was 2142, but now your risk is 3742 because that's how long it takes for the deductible to kick in. So this typically leads to having to close out this option, the 610s, and then move it up. And then each time you do it, it's at a loss. The last thing I want to mention is the idea of using short calls. Short calls offset a very small amount of risk. So if you're putting on a short call to hedge your position, not only are you hedging very, very little, but more often than not, people will do it at a 1-to-1 ratio and cap your upside potential, which is a terrible trade-off. So if you want to sell calls against stock, there's no problem, but I would just view it as I'm trying to collect some premium. Yes, it does offset a little bit of the risk, but that's not the primary reason for the trades going on. I'm just trying to get some premium, and then I would always do it at a ratio. That last part's really important. So if we think about just some broad hedging strategies, if you have, let's say, a long delta position, in this case, your long stock, the base ideas, you could buy a put, you could sell a call. Now, there's a strategy called a collar where you can combine both of those. The idea of a collar is you're going to offset a little bit of the downside risk through the put, but you're going to offset some of the cost associated with that. And let's take a look at what a collar looks like. This is long shares. This is if we sell that call. Notice how you get just a little bit of downside risk reduction, not much. And then if we buy the put on top of it, then what do you notice? You now have a synthetic vertical. You're capping your upside and you're capping the downside. So unless there's a very specific reason to put this on, you love the stock, but you don't want to see it move, like that's kind of the world in which this would go on. The best thing I could offer for you to keep in mind is risk is part of trading. You have to clearly define the risk that you are comfortable with. And then if you're trying to scrub away all your risk, you are also scrubbing away all your returns. We went over a scenario in the Outlier Pro community where somebody was asking about using something like VIX. VIX is another way to light your money on fire because it's very, very expensive. Same here, because if you take a look at the puts, the cost of the puts for a 30 delta is $6.43. The cost for the similar 30 delta short call is $4.54. It's a $2 difference. That's put skew. VIX essentially has that to the upside where the calls are very expensive. Any questions? Let me know. Be an outlier. See y'all later.